Hey everybody, welcome to Trading Capital's daily analysis video. I'm your head market analyst here, Curtis Scouten, jumping into the charts on this November 14th. So overall, the day today finished negative, and it's important to recognize what key technical levels we hit today and why we hit them, and arguably why we saw a little bit of a late day sell-off. So pretty much the market was holding positive all day long today. Let's just flip to the intraday 10-minute chart just so we can see the action. So basically this is where we had our gap down, a little bit of pre-market, and then we rallied up, had a little bit of a dump into the intraday morning action, and then the markets were rallying all day long, and they substantially looked like they were holding their higher highs and looking to potentially consolidate above this key support zone. But needless to say, at the end of the day, the market started fizzling out. Basically, you had a sharp sell-off near the end of the day that took out the low of the day and made a new low, and it looks to be you're actually now putting in a little bit of a bear flag. So potentially, this is the fact, one of the reasons the sell-off is occurring is because we have PPI data in the morning tomorrow around 8:30 a.m. That is the producer price inflation or index. And basically that is monitoring and tracking inflation on the producer side, so companies and businesses. So if we get a lower than expected number, the markets could potentially rally, but it's not going to be a rally like we had during the CPI. The CPI was, 5, 6, 7% reversal day, depending on which index you look at. But this PPI data will certainly not be as strong, considering that the markets have had a beautiful move into key resistance levels. There are many charts out there, big quality names that are overbought, which we'll discuss a few of them, like Exxon and VLO and Caterpillar especially, and Gilead Sciences. I mean, some of these charts are just absolutely insane. But nonetheless, with the S&P being into resistance, the key thing about this level, which we tagged on Friday, and then we made a new high today, and basically couldn't close above that level, despite making an intraday high, we reversed and took out the high of Friday's candle. So that is key, because this is a key COVID trend line connecting your pivot freak out low during your COVID collapse, and then your major pivot low in June. So that was basically before you had your big summer rally. And you've now retraced back to that level. So the important thing about this technical breakdown, which occurred over here, you had your wide range candle over here, which confirmed and led the breakdown. And then you basically started trending lower. So the key thing about this area and retracing is you've now are giving the bulls an opportunity to really show if this market has some more upside, or if there is going to be some continued strength. This is a pivotal first battle level for the bulls. If they cannot recapture this, this market is likely going down. One of the reasons I think they're going to fail at recapturing this is just due to the fact that there's so much resistance up ahead. Not only do we have this beautiful trend line over here, you can draw a gap fill over here. You have your secondary gap fill. You also have your original neckline, which retraces basically your left shoulder here, your head, your right shoulder, which triggered the hidden shoulders topping formation. You didn't fulfill the downside completely, but you could also retrace to that neckline. So there's just a whole confluence of resistance up in this area, which doesn't give the markets much upside strength, in my opinion, without some serious bullish consolidation, which I just don't think we're going to get based off of some of the crazy extended moves in variety of names. So the big level is, can the bulls confirm and close above this on the SPY? The PPI data, if it comes in better than expected, may push us into these gap fill levels. We'll just have to continue to monitor. But even if it does, we're accumulating shorts. This market, I do think, still has to make lower lows and test basically the pre-COVID high around 323 at the minimum. That would make sense to basically negate the whole COVID crazy bubble. And considering you've broken key trends, which was your COVID bubble trend, and now you're retracing to that trend in an environment where the QT is ramped up, and basically I think there's global conditions that are weakening across the whole world, which should put a major strain on the overall S&P 500. Certain companies will perform better than others, but in an overall bear market, I think that eventually all companies will head lower compared to where they're relatively trading today. If we take a look at the QQQ, the Nasdaq has basically also hit some resistance. This is your first level that you tagged, and you've put in a beautiful reversal doji candle. It's also a key level connecting your pivot low in October, which basically intersects with your two wide range red bar sell-offs. And then you hit your high on Friday, which you pierced that level, but you were unable to close it despite making a new intraday high on the Qs. But again, the Qs are kind of a little bit showing a little bit more relative weakness in comparison to the S&P 500. But then again, the Qs did fill the key technical daily gap on this chart, as opposed to the S&P 500 didn't. So in my mind, the S&P 500 is still vulnerable because it has larger gaps to the downside, pulling it in nature. But again, you do have a technical gap down here, another one over here. So needless to say, I think the markets are just on borrowed times. Even if you look at the Dow, so the DJIA, we'll just do the futures chart. You can see on the Dow that you basically had a short-term potential breakout. And this is the thing that markets love to do, and they've certainly been doing it with more precision over the last couple of years, I just think, to algorithmic trading. But you've had a breakout on the Dow. You have not confirmed that breakout. It looks to be bullishly consolidating, but again, you have not confirmed that breakout. So often what these institutions want to do, and Options X is this week, is they like to suck in newbie traders who think that the Dow is broken out, bullishly consolidating, before they slam it right back under this downsloping trend line of resistance. So again, that's the big level. And let's just say we do confirm and break out above that. You have a major pivot resistance here at 34,133, and then another one coming up here. But tons of resistance into this overall trend area. And just due to the fact that, look at these moves, boom, straight up. What goes straight up comes straight down. What goes straight up usually comes straight down. The difference between this move over here and these moves, if you look at the angle of this move, it's a lot less steeper in nature, despite it still being very aggressive. I mean, this was an aggressive move off the lows. This is an aggressive move, but this overall trend is certainly less of a degree of an angle compared to this move, compared to this move. So it does dictate that the likelihood of this move to pull back at the very minimum is certainly highly probable, and I think that's what we're going to get. Let me just go over a couple other sectors here. So oil is showing some basically some bearish signals, in my opinion, similar to that fake out breakout pattern that is potentially occurring on the Dow, where you had a breakout here on the Dow. Oil did the same thing. You had a breakout, you had another test candle which made a new intraday high, but were unable to confirm above that previous breakout high. And then look what happened to oil. Failed breakout. Boom, you've collapsed, closed back under this key red trend line. And oil, in my mind, is heading, you have two stops. You'll have an 82, 60 and change level, and then you'll fill this gap fill at the definite. That's kind of my downside for now in terms of oil. If economic conditions worsen, I think that a big level we have to continue to watch on oil will basically be this 57.40 level. That's going to be your big level here before you broke out, where you retrace back down and started basically making a series of higher highs and higher lows. So I think basically retracing to that major pattern before you had your inevitable COVID sell-off, I think that is probably a pretty good area for oil to retrace to. Now, if we went through some sort of a systemic financial crisis or collapse, or the housing market in certain countries collapse, or a sovereign debt crisis, then I think we could retrace to this consolidation zone. So you have a pretty big range of 43.90 to about 36.75. That is my worst case for oil. Obviously, we have seen oil go negative. Obviously, you don't see it on this WTI chart, but I don't expect oil to go negative this go around, considering how things are in the global affairs. Let's take a look at natural gas. Natural gas is just putting in a little bit of a bearish consolidation, in my opinion. This pattern is actually very tricky because you have a minor bullish pattern potential here, mixed in with a little bit of a minor bearish pattern. So it's a very tricky trade. No trade for me. In my mind, I think natural gas is heading lower based off of the oil signals. Again, if oil is collapsing, it's generally signaling something for the economy, and that's certainly, I think, going to play catch up in stocks. If we take a look at gold, let me just pull up the gold chart. Gold has been pretty stellar in its performance. Obviously, we trimmed about half our position at the highs here on Friday. Gold basically has had a little bit of it's getting bought back up. It looks like it's getting, lots of buyers and bidders' attention. My next stop for gold, if it doesn't have a pullback, in my mind, the reason we sold is gold needs to have a pullback. Whenever you see a move like this, again, this angle, it's nasty. I don't like it. It's not sustainable. Over here, it wasn't sustainable. Over here, it wasn't sustainable. Basically, over here, it wasn't sustainable. So again, my mind, in a bear market, these rip-roaring rallies are what trap and lure people in because they think a bottom is in. And then because they're so extended in the short term, they ended up having these sharp pullbacks which catch a lot of traders off guard and put them underwater on their trade. But nonetheless, gold can continue to consolidate a little bit lower, maybe pull back to 1721. As long as it holds this first initial breakout green bar, that is all still technically inside bar bullish consolidation. And you could get a retrace back to this neckline. You have a pivot to a pivot to a pivot high. That looks to me where you're going. You obviously have some resistance here at 1805. That was our first resistance level. But if you somehow get through 1805, then you're going to around 1830, 1835 and change. So again, that's kind of my max upside for gold in this little bit of a next 3 to 6 month cycle. I think gold, to be honest, I love gold, don't get me wrong, but in my mind, I think gold is going to achieve a new low. I think gold is going to take out this bottoming zone here. One of the reasons why I don't like this zone over here and why I think gold is ultimately heading lower, I think gold is going to get a retrace back to this key trend line, going back to 2008 pivot to 2018 pivot. I think gold is going to be retracing back to that, basically back to that trend line at some point in time once the markets start trending much lower and there's a potential liquidity crisis event in the markets. But in terms of gold, why I think it's going to go lower is it just hasn't achieved the full downside move. I think it's going to get caught in a margin call squeeze. If gold heads down to these levels, I will start accumulating once again. And typically when you have a triple bottom, from my experience over the years, triple bottoms don't prove to be a stellar or good base. Generally, they provide a little bit of an interim bounce. Most cases, they actually break down, though, the triple bottom. So I don't like this triple bottom zone, especially since the bottoms are in such close proximity. In my mind, that, if you say you have a support level here, this support level has been tagged way too many times. It's weakened now, that I think if gold comes down for another flush, it's really going to spook and shake out a lot of buyers, which ultimately will probably flush it even lower than most people expect. And I think, again, that's probably just on the basis of a mass liquidation in the stock market, a margin call event, where there's a collapse in stocks at a faster rate than most people anticipated, which put them under pressure in terms of having to cover margin positions. Let's take a look at Bitcoin, BTC, USD. We are short Bitcoin, obviously, in the money on all three of our positions right now, ETH, Uniswap, and Bitcoin. Bitcoin, to me, you're probably heading, basically you have a few stops. Once you break this consolidation pattern down, I think you're heading to 13,842. You can see you have a down sloping trend line connecting these two pivots. That will be a little bit of minor support in this pattern if it collapsed down there. But ultimately where I think Bitcoin is actually going to head is there's a cool channel here, which basically, let me just put this one in the background, shall we? So there's an interesting channel here where Bitcoin was trading in 2021, and then it broke out, retraced over here, broke out, made new highs, blah, 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 blah. And then Bitcoin's actually fallen and retraced over here to this channel, bounced, got a technical bounce off of that level. And that is very intriguing because typically when you hit a level of support and you're likely heading, and it's a downsloping trend line, it's very likely that you're going to retrace back to that level of support again. So if you just carry this trend line forward, this parallel channel, you basically will find a mega support. So, and this is downsloping, so obviously the support line is heading lower as we go on in time. But it looks like Bitcoin could have a big drop down to anywhere between 11.5 all the way down to say 10,000 would be a really solid range. and it will just so happen to coincide. If we flip back on this parallel channel and put this one back in on our chart so we can see, basically the exact center point of that channel is this dotted line. So when you have a confluence of this parallel channel's center point plus this parallel channel, the major support high of it, confluencing really in the same vicinity, and then you accompany it with some major support pivots over here around the 11.5 or even the 10,000 level, that is a technical level that will most likely hit, and it will probably be a great buying opportunity. So we're just going to have to continue to monitor that. But I do think Bitcoin is in extreme trouble. If we look at the weekly chart on Bitcoin, clear as day, you've broken this bear flag. That is a nasty break. If you recall this bear flag over here, let me just erase some of these channels. If you recall this bear flag over here, you broke it, confirmed. Look what happened after you broke that. Basically, Bitcoin ended up going from 34 down to 17.5. You've now broken that. You haven't confirmed, but this is a very tough candle for me to believe that you're not going to be able to, that you're going to be able to get through and recapture. I think Bitcoin is basically done. The chart is broken. There's downside in my mind for Bitcoin, and that's pretty much how I see it. The key thing about this is that this purple line over here, this 2017 high, you have not confirmed, you have basically, this is the lowest level you've confirmed on a weekly basis below that level since trading, back in 2017. So that is a pretty big key support level that we're now breaching and potentially confirming, but this is not a healthy chart to get in front of. I think the big level for Bitcoin is basically around somewhere on the top of this downsloping parallel channel. That's going to be a key level for us to accumulate yet again for another swing. So I mean, we're talking about if we see a potential dump in Bitcoin, another liquidity event, and you never know what's around the corner with FTX going under, there's probably more exposure that's going to come out over the next 1 to 2 months or 1 to 3 months, because when you have the second biggest exchange going under in the crypto space, that is going to take other players with it. I mean, we already saw BlockFi, and to be honest, I made a video 2 months ago because I was on BlockFi. I had a large stake of my long-term position capital for crypto where it was earning yield. And basically I alerted all our members in one of our previous daily analysis video. I said I'm going to be taking my money off of these exchanges because I'm fearing a liquidity crunch, a liquidity event, and look what's happened 2 months later. BlockFi goes under, FTX is going under. So people's funds are trapped and you can kiss that money gone. So, but I was able to get my money out basically 2.5 months ago, and there was also fair warning in my videos. So congrats if you did get your money off. But if you've lost, I mean, that's very unfortunate, and it's truly saddens that the crypto space has to take this kind of a hit to basically build back better and get stronger. So daily chart on Bitcoin, uber bearish. Even after that mega rally in the S&P, you couldn't close above this wide range red bar. This is all bearish consolidation, sucking in retail traders. You're putting in, what looks to be a strong reversal signal here, over here. But again, nothing is more powerful than these two sell-off candles that occurred here. This money is just going to suck new people in wanting to buy before they very likely slam it lower. Let's take a look at another chart that's very interesting. Obviously, we're very net short this market, so we're hoping for potentially a higher print tomorrow. But if we look at the DXY is key because the DXY has had a sharp sell-off. You've broken a key trend line over here. Naturally, you want to retrace back to mega trend lines that you break just to really give the bulls a chance to see if this was a true breakdown or was more of a fake down. So in my mind, I think the US dollar is going to have a bounce back up to 2 levels. You have this downsloping parallel channel, which you could act as a mega resistance. And then you also have this upsloping trend line, which is really confluencing in the same level as that potential parallel channel. So the big question in my mind, and what the charts are kind of telling me in the picture that I'm seeing the more likely outcome that the PPI comes in either, or I don't know what the PPI is going to come in at, but I think the more likely reaction based off of the chart patterns is that the PPI reaction tomorrow is negative for the markets. So in theory, if the PPI comes in hotter than expected or the markets take it as negative, then the dollar will likely bounce. yields will likely bounce, and the stock market will likely fall lower. So I think that the dollar is poised for a retrace bounce all the way up to this, at least this 108.86 level, potentially 109 and change. And that would certainly be, you know, about a $2 bounce from our current levels, which will put pressure on the overall markets if the dollar captures that bounce. Now, it doesn't say the dollar is going to basically hold this level. It's just your first big resistance test for the overall dollar, where to know if we're actually starting a potential consolidation trending down. So again, let's just continue to watch that, see how that plays out. Based off of the US 2-year yield, let's just see if there's any insights that the bond market is giving us. So basically on the 2-year yield, sorry, I just messed up that. Again, the 2-year yield, you were trading inside of this parallel channel. You broke down on this 3-bar surge. You arguably have retraced back to the breakdown zone. The big question tomorrow is, can we get above that level and close above it? If we can, then the next retrace level is this key important trend line, connecting your pivot in August to your pivot over here and your wide range red bar breakdown. So that's going to be the second big level on yields that we need to watch. Can yields get into this parallel channel? From then on, can they retrace back to this orange upsloping trend line? Again, this red bar is your mega resistance on yields. I don't think that we're going to get through this, but even if we start chopping and consolidating at this, you know, anything above this 4% range, that is still extremely difficult on the overall economy. In my mind, let's take a look at a couple stocks. So Caterpillar, let me just clear some of these for you. So I want to look at Caterpillar's weekly chart. Caterpillar's weekly chart is just fascinating to me. Many people are calling this a bull flag consolidation, looking for Caterpillar to break out and go much higher. I'm very different. We're shorting Caterpillar. It's a big short position that we're touching base on. But basically, Caterpillar from the low here in September has had 1 week, 2 week, 3 week, 4 week, 5 week, 6 weeks, 7 weeks, and at the high today it was 8 weeks in a row of upside. Obviously, with 3 days left in this market, but 7 weeks of continuous upside with potentially another one formed today. That is just an exceptional overbought scenario, especially in the overall climate. When you look at where Caterpillar put in its top here in May of 2021, look where interest rates were. Look where the US 2-year yield was. We were trading still at the zero bound mark. Now look at the rate of change move in interest rates, and look where Caterpillar's trading, back at the previous highs. This chart is just acting as a collapse waiting to happen. In my mind, yes, we've had a mass rotation out of tech and risk assets into more of these value plays, but I just can't justifiably make sense in terms of this valuation now and this move, considering the overall backdrop in which the economy is heading into. Once economic data and GDP start to decline more, in which they will as these interest rate hikes start to filter through the economy. And keep in mind, the last 4 0.75% hikes have not even filtered through the economy. They have not hit assets or the real economy yet. So again, when you're just simply looking at it on an interest rate valuation, Caterpillar's made a new high today, despite interest rates basically being 4 times higher than they were when it had its initial sell-off in basically May. So again, that is just one metric. If we minimize this US 2-year yield and we look at the 10-year data, actually we'll bring both up. But I want to show you the forward PE ratios. So again, we're on the weekly chart of Caterpillar, but this is giving us a little bit of a historic guide and how the forward PE is actually matching a very similar trend to what the last interest rate cycle was bringing. And this interest rate cycle is arguably a lot worse and a lot more aggressive and a lot more hawkish and a lot more dangerous compared to what we went through in 2016 to 2018. So 2016, we started an interest rate hiking period. And you can see it over here on the chart, this orange trend line. You can see that in 2016, interest rates starting to tick up. This is when the Fed was going on a path of raising rates and starting to tighten monetary policy. And what initially happened to Caterpillar, if we actually just bring up the chart pattern, on the actual initial stages of raising rates, so basically if we look in 2016 when we had our big jump in rates from here all the way to here, Caterpillar actually started rallying, having an extension move as rates were rising. And that's because typically when you're in an interest rate environment, you're going to see the money rotation out of tech and risk assets into more of these value plays that are generating good cash flow and have a solid, stable business. So this is what we saw in 2016. As rates were rising, these stocks rose. But then interest rates started to make a little bit of a top and started falling. This is arguably the period where Caterpillar started making these big movements to the downside, when interest rates started topping and things started falling. So again, you have to realize that when interest rates start falling aggressively, it's likely because the economy is weakening. And that's certainly what we saw here, is the economy starting to weaken, and then the COVID crisis. But nonetheless, as these interest rates are astronomically higher than really any of the recent periods that Caterpillar has been trading, despite Caterpillar making a new all-time high, I think Caterpillar is going to be a victim to a mass slowdown in the global economy that is going to hit its stock price very hard, and it's going to capture a lot of those funds that just pile into this as a safety play off guard. And when you look at the PE ratio in 2016, it peaked as the interest rate hike cycle was really getting its legs going. Then it started to fall in 2017, and then by the time 2018 hit, that's when interest rates started falling sharply, and this is when the Powell pivot occurred in 2018. But look at what happened. The forward PE basically collapsed from 28 to basically 1090. Here we're following a very similar pattern where forward PE was roughly 33, interest rates were low, interest rates started rising, forward PE started getting hit a little bit. So this is kind of your 2021 period is matching up to your 2027 period. And then we started trading, going along. We hit a peak in interest rates, which signified the economy going to be slowing down drastically. So therefore, central bank policy needs to slow down. And basically, your forward PE dropped off a cliff from basically 24 all the way down to 1092. That was more than a 50% cut. So again, you're here at 19. Interest rates are potentially topping, therefore signaling a potential slowdown in federal tightening. And the PE, if following the same cycle, should drop off a cliff. If you're following the 2017 to 2018 window, it was more than a 50% cut in forward PE, which would take this stock down to around $9.850 or so, $9, $9.50. So again, that would mean that its valuation has to come in substantially, and that most of this rally will probably be negated with further downside. But that was just a little bit of an education. Sorry about rambling on. I just think it's a very intriguing chart. A lot of these companies, I mean, even if we look at Gilead weekly, Gilead is just crazy. I mean, you rarely see Gilead making, despite it hasn't made a new all-time high. This is 2015. You know, this was your 2020. So Gilead has basically 1, 2, 3, 4, 5, 6, 7 weeks of upside. That is insane move, just overbought in every scenario. I think Gilead still retraces back to the 71 to 70 zone as a big support, or even this downsloping parallel channel, which was your previous breakout zone right over here. So, but some of these moves are just astronomically blowing my mind when I see in the coming months that economic conditions are going to deteriorate faster than people think, especially since these interest rate hikes are going to be working themselves through the overall economy. But again, if we look at the weekly chart on the SPY, you had a break above that short-term weekly moving average. Looks to be like you were recapturing it, just like this event over here. And look what is potentially forming. A little bit of a reversal signal off of that major resistance. And the question is, are we going to make new lows? Are we going to test the lower range here? Time will tell, but I certainly think it's very likely that we do. That's it for today's video. Please give this video a big like down below, and we'll buckle up tomorrow and the remainder of the week, as it is options, so there's plenty of choppy action. You know, it's pretty much feeling like we're seasick out here in these markets, just with the overall